Hello and welcome to Home Depot stock intrinsic analysis. Today we will find how much does Home Depot stock actually worth, or in other words, how much you should pay to acquire it. But before we do that, I want to remind you that this video is not financial advice and it's for entertainment purposes only. If you are new to this channel, we perform this analysis by heavily depending on the annual reports for a number of the prior years that Home Depot filed with the Securities and Exchange Commission. Because the annual reports include so much financial and non-financial information about the business, and in my opinion, every investor should have the habit of reading these reports before investing to make an educated decision and stand by that decision. These annual and quarterly reports can be downloaded from the SEC website by using the ticker symbol of the stock. And in this Excel file, I compiled the relevant information to forecast next year's numbers and to get to the intrinsic value of the stock. Home Depot, for those who are not familiar with it or those who are outside the United States, is a chain of 2,317 stores in the United States, Puerto Rico, Canada, and Mexico, offering building materials, home improvement products, lawn and garden products, decor products, and other products in the similar lines. The company has one equity security or one class of stock that is registered with the SEC under the ticker symbol HD. And Home Depot reports the results of its operation in a fiscal year that ends on the 30th of January of every year. So in less than a month, they will finish their 2022 year, and 40 days after the year end, they should make the 2022 annual report available to the public by filing it with the SEC. The audited report of the financial statements is part of every annual report, and for 2021, it is a clean report. This simply means that the external auditing company doesn't have any concerns about the financial statements, so the investors and creditors can trust the numbers in them. These rows with the green titles contain information pulled directly from all three financial statements: the income statement, the balance sheet statement, and the cash flow statement. And the blue ones are ones with ratios or amounts that we are calculating for this analysis. Home Depot has two operating segments, and they are products and services, and as we can see, the majority of 2021 revenue was from selling products. And geographically, the majority of the revenue is from the United States, and only 8% of the revenue is from the international market. Next is checking the company's performance year over year. We can see that the revenue is increasing every year, which is a healthy sign because it means that the customers are happy and returning to Home Depot. Moving on to the next tab, in this graph we can compare the revenue to the cost of revenue and operating expenses to check each one of these three items' growth. And we can tell by looking at the graph that the growth of these two expenses is very normal, which means that the management is only spending on the necessary and ordinary expenses to make sure that they are maximizing the value created by the operations to the shareholders. Scrolling down to the free cash flow, we can see that it took a nosedive in 2021 after continued growth since 2015. The reason is that there was a mismanagement in the inventory. In other words, they have more inventory levels than they are used to, because it's about $6 billion more than prior year in the balance sheet statement, and about $5.4 billion of that increase reduced the cash generated from the operating activities, as we can see here in the cash flow statement, because the inventory is one of the items that adjust the net income to reach the cash generated from the operating activities. So if they didn't have a higher inventory level in 2021, then the free cash flow would have been more than what they reported, and theoretically, the stock price would have been higher. Moving on to check the debt to assets ratio, it's 54% of assets in 2021, which is in my opinion is taking its first step towards the too much debt zone, which is not a very good sign, because having a higher debt to assets ratio will limit their ability to have future growth depending on debt. Because at some point in the near future, no one will loan them anymore, or it will be hard to get a new loan. And loans are necessary for growth because, for example, each new Home Depot store created requires so much cash to fill the store with all the products, equipment, and systems that are required with every location. But for the time being, we should not be worried about Home Depot's ability to service the debt because the times interest earned ratio is 19 in 2021. Which means, in other words, that Home Depot made in earnings 19 times the interest expense, which means that they can afford to pay the interest expense. Next, we should check the outstanding shares, and the good news is that Home Depot is buying back their shares with an average rate of 2.9% of the total outstanding shares every year. So in our forecast, we should consider this fact when forecasting 2022 outstanding shares. Dividend investors are going to love Home Depot because it's a dividend company and distributed about $7.76 in 2021, which is about 2% yield. Now we can move to the forecast part, and we should start by forecasting the revenue because the revenue is the lifeline of any company, and without revenue from regular operations, the company has no value. So as usual, we go over the annual report to understand the factors that drive the revenue, and we want to know these factors so that we can make an accurate revenue forecast as possible as we can. And in Home Depot's case, the factor that drives the revenue is the number of stores that the company has, because simply, the more stores are there, the easier customers can find Home Depot store and make a purchase, and that would increase Home Depot's market share in this industry. There is another metric that is commonly used with the retail industry, which is the revenue per square foot. I know both metrics are very similar, but I will use both metrics to forecast 2022, and we should have similar numbers. All the numbers here are from the annual reports, except for this column which contains the forecast numbers. This line is the number of stores Home Depot had each year, and the line below it is the annual revenue. And what I did is calculating the revenue to the number of stores ratio, or in other words, how much on average each store makes in revenue. For example, in 2021, each store made about $65 million in revenue. And then I wanted to see the change in that ratio every year, and as we can see here, it ranges between 2 to 20% with an average of 9% for all the prior years. So to be conservative in our forecast, in my opinion, we should use 9% increase in the revenue per store, which will give us about $70 million in revenue per store per year for 2022. Next, we need to know how many stores Home Depot will have by the end of 2022. We do have Q3 report, and the company reported that only 2 new stores were open in the first 9 months of 2022 fiscal year. So we'll use this number, and multiplying it by the revenue of each store, it will give us the 2022 revenue forecast, and in my opinion, it's about $163 billion. And it is very close to the revenue forecast using sales or revenue per square foot and total retail square feet in 2022. So in 2021, there were 241 million retail square feet, and sales per square foot were about $605 per year. Now we have to forecast how many retail square feet will be in 2022 and forecast the sales per square feet. In my opinion, we should be conservative in our forecast and assume there will only be 3 million more square feet and an increase of 9% in sales per square foot. This will give us about $161 billion in revenue, which is about 1.2% off than the first revenue forecast that we just did using the number of stores and the revenue per store. So I decided to take the average of these two forecasts. This means that 2022 revenue forecast is about $162.9 billion. Next, we need to know how much of that revenue will be free cash flow, and for this, we should use the free cash flow to revenue ratio. If we look here, we can see that it is very consistent and ranges between 9 to 12%. So in my opinion, we should use the average that is about 10%. I want to quickly remind you about the CVS analysis that we did a few days ago. And in that video, we said we had 2 concerns, and one of them was the free cash flow to revenue ratio being at 5%, and it was the lowest of all the companies that we have seen on this channel. But we don't have a similar concern here because Home Depot free cash flow to revenue ratio is acceptable level, which is 10%. Next, we need to know how much free cash flow will be awarded for each share. So we need to forecast the outstanding shares by the end of 2022. Using Q3 report, we know that Home Depot continued to buy back their shares and reduce the outstanding shares by 1.37% or about 14 million shares. So in my opinion, it is safe to say that they will buy back an additional 2 million more shares. We will not use the discount rate because we are less than 1 month away from the end of 2022 fiscal year. And finally, we will start with 5% return on investment. The return on investment is a number that you decide. You can ask for a return on investment of 10% and adjust the stock price accordingly, or you can ask for 2%. It is 100% up to you. So these four numbers are what we need to find the intrinsic value of the stock. So in my opinion, 2022 revenue will be 162.9 billion and the total free cash flow will be around 16 billion, which will give us about $16 free cash flow per share. Using 5% return on investment will give us about $320.03 intrinsic value of Home Depot stock. I want to mention that usually 5% return on investment is acceptable for mature companies that doesn't have any concerns, because the investment risk is lower than newer companies. So what happens is that investors think that it's less likely for newer companies to be around the next 10 years, and they will only invest with a high return on investment ratio. In the CVS analysis video, we used 14% for the required return on investment because we had two concerns that raised the risk factors for CVS. But in this case, we don't have any concerns for Home Depot, so in my opinion, 5% return on investment is reasonable rate. The final thing I want to mention, subscribing and liking this video is what motivates me to make more videos, so please support this channel. And please let me know if you have any stock in mind that you want me to prepare an analysis for.